I'm Alan Kenny, Editorial Director with REIT.com, and we're in New York City for REITWeek 2016, NAREIT's Investor Forum at the Waldorf Astoria Hotel. I'm joined by Philip Charls, Chief Executive with EPRA. So Philip, everybody of course is talking about the Brexit, what that means for the United Kingdom's property markets, but also can you give us an idea how that will also affect maybe property markets on the continent as well in Europe?
Yeah, obviously it's a very hot topic. We are a couple of weeks or days more away to the 23rd of June. It's obvious if you look at the UK that it has had an impact on the markets. Year on year volumes are down. I'm not one of the people who's going to predict what might happen to markets on whether it's in the UK or in other European countries. I think one thing is for sure, and that's the general feeling that it's obvious that all of us on either side of the channel would be much better off if the UK stays in rather than be outside of the EU.
And Philip, I came across a very interesting article on your website outlining some of the changes and evolutions in behaviors of European investors. Can you give us an idea of what that might mean for real estate investment?
Yeah, I think it's a great question. I think we are really entering a new stage for the European listed sector. I think there are three main drivers for the investor behavior. Number one is the increased allocation to real estate, and listed real estate included. Obviously, the low interest rates play an important role, but also the greying of society. To give you one example, Norges, which is the biggest sovereign wealth fund in Europe, it's around close to 900 billion assets under management, so it's massive. Up to a number of years ago, say 5-6 years ago, they had zero exposure to real estate. Then they decided to go to 3, then 5, and at this moment, actually in February of this year, Parliament decided to go up to 7%. If you now look at the present situation, and I believe they're not even at 4, so some at 3.5, and of the allocation, 23% is going to the listed space globally. So that is an enormous driver for growth. Second reason I'm positive, if in the US you're very much used to finding systems like defined benefit, like defined contribution instead of defined benefits. If you look at Towers, what's the numbers? 40% is defined benefits, 60% is defined contribution in the US. If you look at Europe, we're nowhere near there. If you look at big countries like Switzerland, like the Netherlands, who are historically countries that have from long time ago pension funds, we're not even at 5%. So I think, and I don't have scientific evidence for this, we are actually going to look into this at EPRA, but I think there is a very clear correlation between the development of defined contribution and the listed real estate, the REIT market in the US. And it's obvious the reasons, it's transparency, it's the liquidity, it's the diversity, and all the reasons we always talk about that are behind this. So again, when we get to that development in the DC market, I'm sure this will be a driver for growth as well. And finally, I talked already about demographics, greying of society. That will lead to a point in time, not now, but in a number of years, where more money is going out of the pension funds than actually coming in. So we get a net outflow of money. That means that, again, that drives liquidity. Funds need to have long-term income-producing assets, and again, for the reasons I said before, liquidity, transparency, the REITs will come in play. So three drivers for growth in the very near future.
Well, that's interesting. I'll be interested to see when you guys find out. So looking lastly, second half of the year, what's going to be EPRA's top priority?
Number one or number two, I think they're equally important for me, is we need education. So we need to explain investors what we mean, whether it's retail investors or institutional investors, what we can do to enhance their performance. And particularly we will focus and continue to focus on the blended approach, whether it's 35, 65, 40, 60, we have all sorts of studies, but the bottom line is that if you use the sector properly, it will enhance your performance. So that's number one. Number two, we spent a lot of time in the last 5-6 years in improving or establishing REIT regimes in countries. Come to mind countries like Spain, Ireland, Italy. They all have their companies up and running now, very successful. And at this moment we are actively involved in two of the remaining major economies in Europe that do not have regimes, either Poland and Sweden. So these are the next two targets, two areas that we are going to spend a lot of time on.
Well, thank you so much, Philip. Always a pleasure.
Thank you.
And for more from REITweek 2016 and more REIT news and analysis, be sure to visit REIT.com.